Let's talk about the First Home Super Saver scheme. So I am super excited about this one. If you can stick with me through the video, I can almost guarantee that I can save you money. If you're a first home buyer, whether you're looking to buy sort of in a few weeks or a few years, there is probably at least $1,000 we can get you. In a lot of cases, it's more like 3,000, or if it's a joint application, it might even be up to 6,000, and we can do that almost immediately. I can also show you there are people that have a deposit in their super that they can use and they don't know about it. So we'll have a look at how we can find that. But the general premise is we can use this scheme. We can put our deposit or part of our deposit into our super. We can withdraw it back. There's a tax benefit of doing so, and then you can actually just have more cash in your bank account. And you don't need to use all your cash for the deposit, so we can still make a benefit even if you're going to have money left over at the end of the day. So if you look on the screen before we go through too much, it depends on your income. So the sweet spot is actually somewhere around 100,000, and it also depends how long your savings for. So if you want to make immediate gains, you want to buy in a few weeks, you're probably looking at savings of about this much. And when I say savings, I literally mean extra cash in the bank that we can get you. And if you're looking at 2 to 3 years, so sometimes we can do this over the period of a few months. You'll see why later. But if you're looking in the long run, it's still really good. You'll get an extra benefit of doing so. And these above figures, they're for individual applicants. So if there are 2 of you, you're applying with your spouse, you can double this amount. Before I can show you how we actually do that, I have to show you the fundamentals of the schemes. But if you stick with me, about towards the end of it, I'll show you the actual magic and how we can recycle your deposit correctly. Quick note on what this actually means. If you're under the First Home Guarantee Scheme and you're under the stamp duty threshold, $1,000 will increase your purchase price by $20,000, subject to affordability, of course, which means $8,000 savings. If you can get that through this scheme, you can increase your purchase price by $160,000. Again, that's under the scheme. It's not quite that much if you're not under the First Home Guarantee Scheme. And the other things you can do with this, so if you instead just use it to reduce your home loan by that amount, if you put in an extra $1,000 at the start, it means you're going to be $2,226 better off over the 30 years. Or if you put $8,000 in, if you manage to save that, reduce your home loan by that much, and you put that in at the start, you're going to be about $17,808 better off in 30 years' time. All right, so the First Home Super Saver Scheme, at its core, what it is you can make concessional contributions, which are pre-tax contributions into your super. You can then draw that back out at 85%, which means you haven't paid your marginal tax rate. And at the end of the day, you have a higher deposit by doing so. It appears to be designed around long-term savings, but the way it's done, you can do things quite quickly. First thing we have to look at or understand is how super actually works. So first you've got these employer contributions. So these do go towards the concessional cap, which we'll talk about in a second, but they cannot be withdrawn for your deposit. So whatever your employer has been paying, it cannot be withdrawn. It has to be voluntary extra contributions, which brings me to the concessional contributions. So if on top of your employer contributions, we make concessional contributions, now these are done with pre-tax dollars, which we can do either by salary sacrificing pre-tax, or we can take our post-tax income, make a contribution, and then draw it back. These are the ones that we can draw back, and these are the ones that we really need for the scheme. So these are really important. Now, the concessional cap that I mentioned, there is a cap of $27,500 is this financial year being 23-24. But from the 1st of July 2024, that'll be increasing to $30,000. If you go over this cap, you can still contribute to your super. However, that's a non-concessional contribution, so that is post-tax. You put money from your bank account into your super. You can withdraw that at a rate of 100%, but there's no benefit to doing so because it's after-tax dollars already. So we don't really care about them. All right, eligibility, let's go through this one quite quickly. So the general gist is that you can't have ever owned a home, so you have to be a first home buyer. You can't have ever previously made a request to release the funds under the First Home Super Saver Scheme. It basically means you have one chance, but once you do that, make that release, they put the cash in your bank and you have 12 to 24 months to buy a property. So it's fairly lenient, but you can't withdraw it for 12 months, put it back, do it again in a few years. You must be purchasing as owner occupied. So to do so, you must move in as soon as practically possible. And that has to be for at least 6 months of the first 12 months. You also have to be 18 years of age. But interestingly, if you are under 18, you can make concessional contributions. So you might be 15, you can make $5,000 a year for 3 years. When you become 18, you can withdraw that $15,000 or 85% of it to use as your deposit, but you can't withdraw until you're 18. Now the guidelines for superannuation withdrawal. So we've gone through this somewhat, but you cannot withdraw the employer's contribution. Everyone asks me this all the time, but you cannot withdraw employer's contributions. Anything before 2017, concessional or not, they're not eligible. The pre-tax contributions, the concessional ones, they can be withdrawn at 85%. So you put 10,000 in, you get 8,500 back. The post-tax ones, 100%, but again, that's not very useful. This bottom one is very important. So there is a $50,000 total cap that you can withdraw. Now that won't affect most people, but if you do it for 4 or 5 years, then yes, you might go over. So just keep an eye on that. But you can also have 15,000 per year as your cap. So you can't put 30,000 into your super this year, withdraw that back out. It's 15,000 per year, and that becomes very, very important. Now, once you put money into your super, as well as the actual withdrawal rate, so you put in 15,000, you can withdraw it at 85%, which means you can get 12,750 back. Now, on top of that, you also get any interest on the contributions. That is not at the rate that your superannuation fund is making money, whether that's higher or lower. That's at the shortfall interest charge. I believe that's set by the government. That's currently 7.34. So we're going to exclude that from our calculations from here on out. But it's a really good savings rate. It's better than a savings account. So any money you put in there, you can at least be confident that you are going to get a good return, as well as the tax benefits, which is what we're interested in. Now, an example of how it works for salary sacrifice and how the benefit is gained. So let's talk about Bob here. He's on 100,000 gross income. He gets 11,000 super on top of that. That is his employer's superannuation contribution, which we cannot withdraw. And he has everyday expenses of 60,000 per annum. So after he pays for tax, his fuel, his rent, etc., is going to cost him 60,000 per annum. So if he doesn't have the First Home Super Saver Scheme, he gets 100,000 gross, and after tax he gets $75,033, which means if we take off his expenses, we're left with $15,033 in savings per year for Bob. However, if he uses the First Home Super Saver Scheme, and let's say we use it to the full benefit, so we're going to say, first we're going to calculate how much he can put in per year. So the concessional cap is $27,500. We're going to minus the $11,000 that the employers put in, because that goes towards your concessional cap. So he's left with 16.5K of concessional contributions this financial year. However, as I mentioned, there is a cap of 15,000 per year for this scheme. So we'll say he'll do 15,000 extra in super contributions, and that equates to 1,250 per month. So each month, and he approaches his employer to set this up, he salary sacrifices 1,250 of his pre-tax dollars into his superannuation account. What this does is at the end of the year, it reduces his take-home pay from 75,000 down to 65,208. However, it also means at the end of the day, he's got 50, or at the end of the year, he's got 15,000 in super. We can withdraw that at 0.85%, oh, sorry, 85%, which gives us 12,750, I think, yep, 12,750. So now Bob has 65,000 plus 12,750, which gives us 77,950.58 minus his $60,000 in contributions, in expenses, which leaves him with 17,958. So by doing the First Home Super Saver Scheme for 1 year, he has gained about 2,920 something. I can't even read my own writing, but roughly $2,920. And he's out of pocket $0. All he's done is set up that salary sacrifice and use this scheme. That is probably the best way to use this scheme if it suits you. If you are saving in the long run, I would strongly recommend just setting this up, because if he does this for 3 years, he's got a $9,000 benefit plus the interest he gets on that super. If Bob's got a partner who does the same thing, they save a deposit over 3 years, they're $18,000 better off. So they can save whatever they want as well, but they will have $18,000 more cash in the bank than if they didn't do this. Now, I promised I'd show you how to find superannuation or a deposit in your superannuation if you have one. Now, this is a real life example. I actually think I've taken the wrong snippet and used the wrong math for it, but we'll use this as an example. So there's a lot of government employees, this one was a teacher specifically, that have had their employer ask for years or enforce for years that they make a employee contribution into their super. Now, if this has been you, and if you don't know, you can check your pay slips, but if this has been you and you've been making contributions for the last 3 years or so, you can actually go and get an ATO determination that will tell you how much you have eligible to withdraw. You don't have to go and check your pay slips. It has all the information there. This teacher, she came to me, we were making a plan for a year down the track of buying a property, but I looked at her pay slips and said, hey, have you been making these employee contributions for long? And she said, yeah, my whole career. So she went ahead and got an ATO determination, and we found it was roughly $25,000 or something in her super that she could withdraw. We did that, and she bought a house about a month later. Whether the employee makes you do it or not, if you've been making voluntary contributions after 2017 for any reason, absolutely worth getting an ATO determination, checking where you sit. Now, the contributions, this is where it gets a little bit more complicated. So we've gone through this pre-tax salary sacrifice, and as I said, if you're not buying a property soon, this is what you should do if you can. But your employer doesn't have to let you do this. So if you talk to your employer and they say, no, we don't do that, you can still make post-tax contributions. Now, we'll go through that a bit more in a second, but the general gist is you get your normal pay into your bank, you make a contribution into super, and you claim that as a tax deduction, and you still get the same benefit. Sole traders generally get pre-tax money into their bank account anyway, so they can make that contribution, claim it on their tax, and it's fairly straightforward. And a company, you could be getting paid a wage, you could be taking it as dividends. There's a lot of different ways. Just talk to your accountant if you want to do this. But the other thing to check before you set anything up, ATO recommends that you check with your super fund that they will release the funds for this scheme. I've never heard of a super fund that does not do that, but if you're going to start putting money in, I would recommend give them a call and just make sure that you'll be able to get the money back when you need it. So this is the pre and post tax contributions, comparing them. I'll go through the math quite quickly, but I just want to show you an example of how it actually works out. So if you got, again, 100,000 plus super, your take home pay is 75,000. Now, if you want to put $12,000 into your super over a year, this will reduce, if we do that via salary sacrifice, that's over on the left, this will reduce your annual take home pay to 67,173, which reduces your take home pay by 7,860. However, because you've got that 12,000, you can actually withdraw 10,200. So you got 7,800 less in the bank. However, you've got 10,200 more available for your deposit, so you've gained a benefit of 2,340. If instead you can't do the salary sacrifice, whether your employer doesn't let you, or maybe you've missed the boat, it's approaching the end of the financial year, and you just didn't know about this, then you can instead take $12,000 from your bank account. You put that into your super, so you make a payment directly to your super, and then again you'll have 12,000 more in your super, of which you can withdraw 10,200. You then claim a tax deduction on your tax return of $12,000, which increases your tax return. If we work off a zero tax return, it'll bring your tax return up to 4,140. If we look at this, we've got 10,200 super available. We've got cash from the tax return of 4,140. We've still got the exact same benefit gained. We've just done it a different way. Now, timing your contributions, this is where it gets pretty complicated, but it's also where it gets really, really interesting and somewhat exciting. So above the line, let's assume that, and again, we're going to keep to 100,000 gross for simple figures. Above the line, let's say you've got $50,000 in the bank in, I don't know, March, whatever. We're not going to do any savings in this. We're just going to assume that we save nothing. After the 1st of July, you've still got 50,000 in the bank, nothing complicated there. But if instead you choose to, before the 1st of July, you choose to put 15,000 of your cash into super, then you're going to have $35,000 left in the bank. Now, the important thing here is if you're trying to buy a house immediately, you've just reduced your borrowing capacity because you've got $35,000 left in the bank. You also have that super in your super, which you can withdraw at 85% here, but the total you actually have now is 47,750. So you've actually got less deposit immediately. The benefit comes in when you do your tax return around here. You get your $15,000 tax deduction. You reduce your tax payable from 24,967 to 19,792, and you get an estimated tax return of 5,175. So once you've done your tax return, you'll have 52,925. Again, we have done no additional savings. All we've done is use this scheme, made the contribution, taken the benefit from a tax return, and we are now better off by $2,925. If you're doing this in March, April, May, June, this is not a big deal, especially if you're not buying a property soon, because you can get the tax return in July and you can have all your funds ready to go. However, the next slide gives a little example of what if we do need all our money. We want to take advantage of this, but we're buying a property before we're going to get our tax return. So we don't want to actually just have the 47,750. We want to get the full benefit. How would we do that? And I got a disclaimer right here. Really, really not an accountant. So I am not an accountant whatsoever. Do your own figures. Check the figures for how it will work out with your income. By all means, talk to your accountant, but do your own due diligence. So this example is strange, but we'll go through it. So same income, same everything. This time we're going to use bulk salary sacrifice. Now we're going to say we've got $100,000 income, and we're going to say we're paid monthly. So in month 1, we're after 1st of July. Sorry, take it back a step. So we're gone after the 1st of July and you want to get this benefit, but you don't want to wait till all the way over here at 30th of June 2025 to get that tax return. So how can we get some of that benefit sooner? If we just take our normal pay and we save 100% of that, we'll ignore expenses. Let's say our expenses come out of our bank account. We got 20K in the bank. We spend 8,000 in expenses over 2 months. We got 12K left over. And then we save 100% just to make things simple. If you don't do anything with the Super Saver scheme, you're going to get 8,333 gross, 6,249 after tax. So at the end of the 2 months pay period, you'll have $12,498 in savings for your deposit. However, if we use our First Home Super Saver scheme down here, then what we can do, and you need a good relationship with your employer, or you just need to be a bit of a pest with payroll. So it's not for everyone, but here's what you could do. You could take your 8,333 gross, and you could say to payroll, hey, I want to salary sacrifice 100% of my salary this month into superannuation. Now, if we do that, we're going to get $0 into our bank. We're going to get $8,333 into our super. Next month, we do some quick math. We say we're trying to get to $15,000 super per the cap. So we say this month, can we please salary sacrifice $6,667 into super? These two will give us $15,000 total. We'll get $758 net into our bank. And then we've got our full $15,000 in super, and we've got the tax benefits by doing it through salary sacrifice. So what we have available for our purchase now is $12,750. When we withdraw this 15,085%, we got $759 cash, which means we now have $13,509 deposit available. It's an increase of, it's more like 1,000, so it's not as good as doing it the other way. Now we've got this $1,000 benefit. However, we look at our tax return when that comes around like a year later. Here's how the figures work out. We got $100,000 gross. We got a concessional contribution of $15,000, so our tax payable has reduced significantly. Now we paid $0 tax in the first 2 months, but in the 3 to 12 month period, we'll pay $20,840, which gives us a tax return of roughly $1,050. That shouldn't be a decimal. And obviously, if we do this, we can't make any additional super contributions for the rest of the year. We've reached our cap right at the start, but you get $1,000 immediately for your deposit. You got $1,000 return a year later. There is still a benefit to be had. And the other thing to remember is, if we have a quick look at the previous slide, there is no reason you can't do both of these things. So if you're approaching July now, and you're buying in 6 months, there's no reason you can't do a big $15,000 contribution now, and then post July, you can start doing your salary sacrifice, or do another contribution if you don't need all your money. But it's $15,000 per financial year. So you can do everything before 1st of July, and then again after 1st of July, and we can sort of get double the benefit. All right, let's quickly go through the logistics of actually withdrawing the super. So we've talked a heck of a lot about putting it in, but let's talk about the actual process to get it out. So firstly, we make the concessional contributions, which we know. Then you get an ATO determination. So that is the name of the document that you get. It looks a bit like this thing on the right that says how much you can get back. And I've got an example of exactly how we get that and what it looks like coming shortly. But if you look at this example, here's your concessional contributions, here's the earnings. So this is the 7.34% we talked about. It is important to note that that's quite significant. So if you're doing this over the long run, the 7% is a lot, and I haven't included that in any of my figures. So when I've said you could save $9,000 over 3 years, I haven't included the 7% that you get on top of that, but that will give you an extra few thousand as well. It does say down here, your FHSS release amount may be used to offset your tax or Commonwealth debts. I've got a slide later, but the general gist is it won't be offset by HECS. So if you've got a HECS debt, you don't need to worry. That's not an issue. It's if you have a tax debt or child support, things like that. So once you've got your ATO determination, the bank will, basically this is considered genuine savings. I'm not going to go into what that means right now, but you may have heard the term. But the bank will use that as if it was money that you've saved over 3 months, and it's very helpful for proving your deposit, but it's as good as a bank statement showing that you've got this $19,000 in the bank. So once you've done that, before you release it, I generally recommend a pre-approval. So we can use the determination to get a pre-approval. And I recommend that because once you request the release, so firstly, it's going to take 1 to 4 weeks to release it. So I'd recommend getting a pre-approval, then get it released before you sign a property so that you have it ready in the bank. It can be a bit stressful if you sign a property contract and you're waiting 4 weeks to actually have the money available to purchase it. And you also never know what might go wrong. Then you have 12 months to purchase property. It also says you have a 12 months extension available. There doesn't seem to be a lot of criteria around that extension. It seems like you basically have 24 months, but I'd recommend aiming for 12 months. Get your pre-approval, release your funds, and then buy a property within 12 months. Because if you don't buy a property in the time frame and you don't get the extension, you have to put the money back into your super and you can't release it again. So make sure you're ready to go. Make sure you're pretty serious about buying. All right, this is how we get the ATO determination. And honestly, if you've done any super contributions, or even if you're not sure, I'd recommend just go and do this right now because it's really quick and easy and really helpful. So you go to your MyGov portal, you go to the ATO portal, and then you go Super, Manage First Home Super Saver Scheme. That will take us onto this page. Tick, tick, yes, we're a first home buyer is the general gist. And then it takes you to this page. It's going to show you all the salary sacrifice contributions. So these, if we look at this amount, for example, this shows up here on the 10th of April, which was only 2 days ago. The pay slip was at the end, I think it was on the 1st of April. The employer paid the super on the 3rd of April, and then it showed up on the 10th of April. So you want to check, if you're going to be doing this through salary sacrifice, especially high amounts, you need to check when your employer pays the superannuation, because some employers pay it monthly and some will pay it quarterly. And if you put a lot in and they don't pay it for another 3 months, the money is stuck until they do pay it. But you can see you can make bulk salary sacrifice contributions. That's not an issue. If you make a post-tax contribution, you manually add it up here, you add it here, and then you add that you're going to claim on tax down here. And once you've done all that, it'll give you a determination. So feel free to have a play around with that. We sort of went through this, but let's quickly go through it again. As I said, when you withdraw it, you're going to, if you have any Commonwealth debt, they can withhold the amount. Which means it can really put a spanner in the works. So just make sure you do not have any income tax debt, business debt, Centrelink debt, or child support debt. They will not use the First Home Super Saver Scheme to pay down your higher educational trade support loan, i.e. HECS, unless that forms part of a tax debt. So if you're behind in your tax payments and that includes HELP, then yes, they may, but generally you're fine if you have a HECS debt. Few other considerations, so guarantors. There are people that buy with a guarantor where you don't actually need a deposit. Let's say you got $20,000 in the bank. You can still get this benefit. Extra home loan payments are always good. So if you don't need the money, you may consider putting $10,000 into your super and using that to reduce the loan amount immediately, because you get that immediate benefit anyway in the sense that your loan amount will be reduced by an extra amount. So even if you don't need a deposit, you can still use it, but whatever you withdraw under the scheme must be used for the deposit. But if you had 50,000 and you're putting in 40,000, you can still do it as much as you want, as long as you use that portion for your deposit and you keep 10,000 of your cash aside for whatever. There are no maximum or minimum deposit requirements for the First Home Super Saver Scheme. There's no requirements on the purchase price. So you can really do it. If you're buying your first home, you can pretty much do it anytime. It works with every other government scheme. There's no issues. And final one is paycalculator.com.au. So this one I actually just wanted to show you because it's a very, very useful tool that you probably want to know about. So let's run an example because, as I said, you need to figure it out yourself. But this is the tool I use and it's generally very, very accurate. So let's say someone decides they have $120,000 gross income and we want to figure out what we should do. So make sure all these are turned off and you can see here's your take-home pay of $88,133 per year. Now, here is your super. It is considered a concessional contribution, so it goes towards your cap, but we can't withdraw that under the scheme. But what we can do with this $13,200 is we can Google the concessional cap for this year, which is 27,500. We can minus the 13,200 that the employer is contributing, and we can see we can do another $14,300 there. So the two ways we could look at doing that, we can either salary sacrifice them, which is the pre-tax dollars through your employer, and we can just say 14,300 per year. And then it will show us the benefit. So you can see the difference. I didn't note it down, but I think it was about $10,000 difference in take-home pay. Let's quickly do the math. So we get take-home pay of 188,133 without doing the 14,000. If we salary sacrifice 14,300, we reduce our take-home pay. And I'm looking at this one up here. We'll reduce our take-home pay by 9,366. However, we've just got 14,300 in our super, which we can withdraw at 85%. So we've got $12,000 available for our deposit, which is a benefit of $2,789 in 1 year. And the other way you can do it is if you want to look at making post-tax contributions. You can see here it's got estimated tax return of $65, but if we make a post-tax contribution, which is the voluntary superannuation here, if we set that to 14,300, then it'll show us. So what do we got? Estimated tax return down here of $4,988. So again, you can do your own math on that to see how it works out, but as a general rule, there is always a benefit to be had. That is probably everything. I will try and put these figures up on the website at some point so you can actually refer to them. Otherwise, if you've got any questions, let me know, but I strongly recommend everyone starts doing this, and especially if you're going to buy a property in sort of 3-5 years, even if you haven't started saving, salary sacrifice $5,000 a year. In 4 or 5 years, you'll probably have a house deposit, and the difference in your take-home pay will not be significant enough that it'll change your life. So really do recommend it.